Welcome to Morningstar. High interest rates are weighing on REITs, but Hong Kong's linked REIT seems to be struggling more than others. Our analyst recently revised downward its fair value estimate by 20% after 7% in March. Our equity analyst, Xavier Lee, is going to tell us what's going on. Hi, Xavier. Why did you reduce linked REIT's fair value estimates?
Hi, Kate. Thank you for having me. We took a fresh look at Link REIT and its portfolio of investment properties. We still like its Hong Kong retail portfolio. They are well located in densely populated residential neighborhoods and targets non-discretionary spending. So these were really resilient through the pandemic, and we expect them to continue to be resilient through different economic cycles. However, the aggressive interest rate hikes over the past 12 months have created uncertainty over asset valuations, and we expect cap rates to expand in the geographies that Link REIT is invested in. So, while the trust valuation cap rates have remained relatively stable in its latest set of results, we think that market cap rates will continue to adjust upward gradually over the next 12 months as financing costs and risk premium increases. Hence, we have baked in a 50 basis point yield expansion for its Hong Kong portfolio and between 75 to 100 basis point yield expansion for its overseas portfolio to reflect this lower real estate value that can be crystallized by the trust through an asset sale in this higher interest rate environment. As a result, our fair value estimate was reduced to Hong Kong dollars 62.3 from Hong Kong dollars $77 per unit.
Does this also tie into a more bearish outlook on the retail and commercial property market in Hong Kong?
Not at all. We are actually positive on the retail outlook for Hong Kong as we expect retail assets in Hong Kong to recover ahead of office properties. The return of tourists following the border reopening earlier this year is already starting to boost retail sales, with first quarter Hong Kong retail sales rebounding strongly. This has grown to a 4.1% year-on-year. So on this note, we think that we are still early days on the path of recovery, with visitor arrivals at only about 40% of pre-pandemic level, even as first quarter retail sales reached about 80% of pre-pandemic level. So we expect growing retail sales to continue to drive retail tenants' performance through the second half of 2023 and boost demand for retail space, especially in popular tourist shopping districts such as Tsim Sha Tsui, as well as Causeway Bay. As for Hong Kong office, we think that recovery will take some time given the high number of office completions in 2022. According to JLL, vacancy rates for Grade A office is around 12.3% as of April 2023. So a key driver for this office recovery in our view is that the pace in which mainland Chinese companies lease up office space now that the borders have reopened. We expect market rents to recover only in 2024 after the overall occupancy level will return to a more normalized level.
So after the cut, the stock is still trading in a 5-star price range. What should investors expect from the REIT, and what will be the factors driving a re-rating?
We think that the trust remains undervalued at current price, with the trust trading at 24% discount to our fair value estimate. But we see units remaining under pressure in the near term, with potential upward re-rating when the trust demonstrates its ability to acquire accretively to justify the rights issue that they did at the start of the year.
Thank you so much, Xavier. For Morningstar, I'm Caitlin.